Most people think the financial mistakes that hurt after 45 are about bad investments. Picking the wrong stock, missing Bitcoin, buying the wrong house at the wrong time. But that's not what actually hurts. What hurts after 45 isn't what you bought. It's who you slowly became. Because by 45, money stops being theoretical. It stops being about upside and starts being about structure. And if your structure is fragile, the pain isn't loud. It's quiet. It's the feeling of knowing you can't change direction easily anymore. It's realizing your income is high, but your options are low. It's understanding that your stress isn't coming from bills, but from being locked in. Most people don't see that coming in their 20s or 30s. They think they have time. I used to think the same. I thought financial pain would look dramatic. Bankruptcy, market crash, job loss. But the real pain after 45 is subtle. It's waking up and realizing you optimized for the wrong version of success. So I want to walk you through the financial mistakes that don't look like mistakes at the time, but compound into regret. Not to scare you, but to shift you early. Because after 45, the math still works, but the flexibility shrinks. The first mistake that hurts after 45 is building a life that requires your current income to survive. Not your best year, not your bonus year, your current income. Somewhere along the way, people let their lifestyle sync perfectly with their earnings. Not aggressively, not recklessly, just gradually. A slightly nicer home, a car that matches the title, better schools, upgraded holidays, subscriptions that feel small but stack. The upgrades feel earned, and they are. But here's what happens. Your fixed costs rise to meet your identity. And once your identity is tied to your lifestyle, it becomes very hard to voluntarily step down. After 45, that hurts. Because that's the age when you start craving margin. You want optionality. You want the ability to say no to certain clients. Shift roles. Reduce stress. But if your monthly burn rate demands your salary, you're not financially independent. You're financially committed. The mistake wasn't spending. The mistake was removing elasticity from your life. And elasticity becomes priceless in your 40s and 50s. The second mistake is confusing net worth with resilience. By 45, many people have respectable portfolios. Equity in a home, retirement accounts, investments. On paper, they look secure, but resilience isn't about totals. It's about access and liquidity. I've seen people with strong net worth numbers panic during temporary income disruption because most of their wealth was locked in property or retirement vehicles they psychologically refused to touch. The financial pain wasn't poverty, it was illiquidity. And illiquidity at 45 feels heavier than at 30, because your runway to rebuild feels shorter. The mistake isn't investing, it's building wealth that looks strong but behaves rigidly. After 45, you value flexibility more than theoretical long-term optimization. But if you didn't design for that earlier, you feel trapped by your own success. The third mistake that hurts is career stagnation disguised as stability. In your 30s, consistency feels mature. You stay in a stable role, you get incremental raises, you avoid risk. It feels responsible. But skills compound the same way money does. If you stopped stretching professionally because your income was good enough, you wake up at 45 and realize your market leverage is lower than you thought. You built income, but you didn't build mobility. That's painful. Because at 45, you don't just want income, you want negotiating power. You want to choose how you work. The mistake wasn't loyalty, it was neglecting skill expansion once comfort arrived. And comfort compounds quietly. Another mistake that shows up after 45 is postponing all risk tolerance to your youth. People are told to take risks while you're young, so they assume once they hit their late 30s or early 40s, risk should disappear. They move everything to safety. Avoid new ventures, stop experimenting. But the risk at 45 isn't volatility, it's stagnation. It's inflation eroding conservative positioning. It's watching your ambition fade because you convinced yourself bold moves have an expiration date. The regret isn't losing money, it's losing momentum. And momentum feels very different when time perception changes. Then there's the mistake of equating financial maturity with emotional suppression. By midlife, many people have discipline. They save, they invest, they manage debt. But they never built a relationship with money that feels calm. They built control, not peace. So even with strong numbers, they live in quiet anxiety. They don't feel safe spending. They don't feel safe stepping back. They don't feel safe accelerating. After 45, that hurts deeply, because you realize wealth without internal safety still feels like scarcity. and the years where you thought peace would arrive never did. The mistake wasn't financial, it was psychological. And psychological misalignment compounds longer than interest. One underestimated mistake is outsourcing financial awareness entirely to automation. Automatic investing is powerful, but some people disengage completely. They stop understanding their numbers, stop reviewing allocations, stop running projections. They assume consistency equals correctness. Then 20 years pass. Their system exists, but they don't feel connected to it. After 45, they struggle to answer simple questions. How long could I stop working? What's my real monthly requirement? How exposed am I to market swings? The mistake wasn't automation, it was detachment. And detachment creates insecurity later because clarity was never built. There's also the mistake of over-prioritizing children's financial support at the expense of personal independence. This one is emotional. By midlife, many parents redirect enormous resources toward their kids, schools, activities, insulation from struggle. It comes from love, but sometimes it comes from fear. Fear that their children will struggle the way they did. The unintended consequence is underfunded retirement or overextended finances. After 45, the realization hits. You can't borrow for retirement. The pain isn't helping your kids. It's recognizing you sacrificed long-term autonomy for short-term comfort. And autonomy becomes precious as energy shifts. Another mistake that hurts is building an identity around being the high earner. When your self-worth attaches to income generation, stepping back feels like diminishing yourself. I've seen people who could financially afford to reduce hours, but emotionally couldn't, because if they weren't producing at peak, who were they? The financial mistake wasn't overspending, it was identity concentration. After 45, you want diversification, not just in assets, but in identity. If you didn't cultivate hobbies, relationships, intellectual growth outside work, the transition into slower seasons feels threatening. That's a financial regret disguised as an existential one. There's also the subtle trap of delaying lifestyle alignment. Some people grind through their 30s assuming their 50s will be the enjoyment phase. They delay travel, delay hobbies, delay time flexibility. The plan sounds efficient. Compound now. Live later. But health and energy don't always follow financial projections. After 45, you may have money but different energy. The regret isn't financial failure, it's time misallocation. The mistake was assuming life happens in chapters you can control. Money compounds. But so does time. And both deserve allocation. One mistake almost nobody talks about is not recalibrating risk exposure as psychological capacity changes. In your 20s, a market drop feels abstract. In your 40s, it feels heavier. Not because the math changed, but because responsibility did. If you never stress-tested your portfolio emotionally, downturns after 45 can trigger panic selling. And panic selling at that stage can permanently impair compounding. The mistake wasn't market timing. It was ignoring your own behavioral volatility. By 45, you should know your temperament. If you don't, markets will teach you painfully. Another painful realization after 45 is underestimating healthcare volatility. Not just insurance, but lifestyle inflation tied to comfort. As people age, convenient spending increases. Time-saving services, private healthcare options, higher quality food. These aren't luxuries, they're protective behaviors. But if your financial plan didn't anticipate rising discretionary needs tied to aging, you feel squeezed unexpectedly. The mistake wasn't spending. It was assuming expenses plateau. They don't. They evolve. There's also the mistake of avoiding financial transparency with your partner. In younger years, couples divide roles. One earns more, one manages bills, one invests. It works until it doesn't. After 45, if one partner lacks financial fluency, stress amplifies during disruption. The regret isn't imbalance, it's fragility. True security includes shared awareness. Without it, you built a system dependent on one person's competence. That's structural risk. Then there's the mistake of ignoring inflation not as a number, but as a lifestyle shift. Inflation isn't just higher prices, it's recalibrated standards. Restaurants feel normal that once felt luxury. Subscription creep accumulates. Technology upgrades become expected. By 45, your baseline cost of normal has shifted upwards subtly over decades. If your investments didn't outrun that shift meaningfully, you don't feel poor. You feel compressed. The mistake wasn't missing a stock. It was underestimating cumulative standard inflation. Another regret that surfaces is realizing you optimized tax efficiency over life efficiency. Some people chase marginal tax savings obsessively. They lock money into structures with penalties for access. They delay enjoyment for after-tax optimization. At 45, they realize they built a technically efficient plan but emotionally rigid life. Taxes matter, but flexibility often matters more than squeezing percentages. One of the deepest regrets after 45 is recognizing you never defined enough. Without a target, accumulation becomes endless. And endless accumulation delays decisions. You don't pivot careers because just a bit more. You don't reduce hours because almost there. Decades pass in the pursuit of undefined sufficiency. The mistake wasn't ambition, it was vagueness. And vagueness delays life. There's also the mistake of not building community wealth. Not financially, but relationally. After 45, networks matter more than ever. Opportunities, partnerships, support. If you isolated yourself in pursuit of productivity, you wake up financially stable but socially thin. That affects earning potential and well-being. Wealth isn't solo. And finally, one mistake that hurts deeply is believing financial discipline guarantees emotional satisfaction. It doesn't. Money amplifies who you already are. If you didn't build purpose alongside portfolios, after 45 you may feel materially secure but directionless. The regret isn't numbers, it's narrative. And narrative shapes fulfillment. The truth is, the financial mistakes that hurt after 45 aren't dramatic. They're structural, identity-based, invisible until flexibility matters more than growth. But here's the hopeful part. Awareness shifts trajectory early. If you build margin instead of maximum lifestyle, build liquidity alongside long-term investments, cultivate skills continuously, define enough, diversify identity, treat time as seriously as returns, then 45 doesn't feel like a reckoning. It feels like leverage. Because the goal isn't to be rich at 45. It's to be free in ways that matter to you. And freedom isn't built in one big decision. It's built in quiet choices no one applauds. The smaller house than you could afford, the promotion you declined because it cost your health, the liquidity you kept instead of maximizing returns, the hobby you maintained, the skill you developed even after comfort arrived, the conversations you had with your partner, the recalibrations you made when your priorities shifted. After 45, you don't regret missing hype. You regret missing alignment. And alignment is something you can build long before midlife arrives. But there is another layer that almost nobody talks about, and this is where the regret becomes sharper. After 45, you begin to understand time differently. In your 20s, a decade feels infinite. In your 30s, it feels substantial. In your 40s, it feels fast. And that shift in time perception changes how financial mistakes feel. The same decision that felt reversible at 30 feels heavier at 45, not because it is mathematically irreversible, but because psychologically it feels more permanent. That's why one of the hidden mistakes is assuming you will always have the emotional energy to rebuild. Energy is a currency, and by midlife you realize it fluctuates. If you structured your finances assuming unlimited stamina, unlimited drive, unlimited hustle, you may wake up and find that what you really crave is sustainability. Not acceleration, sustainability. And if your financial model depends on constant acceleration, that's exhausting. Another mistake that quietly hurts after 45 is neglecting health as a financial asset. People think of health as separate from money. It's not. Your ability to generate income, enjoy experiences, and even manage stress is directly tied to your physical condition. If you deferred sleep, ignored stress, postponed fitness in exchange for productivity, the bill arrives later. Not always dramatically. Sometimes it's subtle. Lower energy, reduced focus, more medical appointments, increased insurance premiums. The financial cost compounds, but so does the opportunity cost. Because the version of you that could have pivoted careers, started something new, or traveled extensively may not have the same capacity anymore. The mistake wasn't working hard. It was assuming your body would compound like your portfolio without maintenance. There's also the mistake of building a financial life that looks impressive but feels heavy. By 45, social comparison can quietly shape your decisions. The house in the better suburb, the private memberships, the visible signals of success. None of these are inherently wrong. But if they were driven by comparison instead of alignment, they become burdens. Because comparison never ends. There's always a bigger house, a higher earner, a more exclusive circle. After 45, chasing that becomes tiring. And if your cost structure is tied to keeping up, the regret isn't envy. It's exhaustion. Another subtle regret is realizing you optimized for certainty in a world that rewards adaptability. You chose the safe path repeatedly, the predictable promotion, the conventional investments, the low volatility route. And while that protected you from downside, it may have also limited upside experiences. After 45, many people don't regret losses they avoided. They regret experiences they never allowed themselves to attempt. Starting a small venture, moving cities, taking a career sabbatical, the mistake wasn't prudence, it was assuming prudence requires rigidity. Financial intelligence includes designing for optional experiments. Without that, life can feel linear, and linear becomes limiting. There's also the emotional weight of realizing you built wealth, but never built a philosophy around it. Money accumulated, but you never asked why. Was it for freedom, for status, for security, for legacy? After 45, that question becomes louder. Because if the why isn't clear, the what feels hollow. And hollow wealth is confusing. You have enough, but you don't feel complete. That's not a spreadsheet issue, that's a narrative issue. Another mistake that surfaces later is underestimating the cost of chronic stress. Financial stress isn't just about not having enough. It's about constant vigilance. If you lived decades in a state of hyper-control, obsessing over markets, obsessing over returns, obsessing over optimization, your nervous system pays a price. After 45, peace becomes more valuable than marginal gains. But if you trained yourself to equate activity with safety, slowing down feels dangerous. That's a difficult trap to escape. One more regret that quietly emerges is not preparing psychologically for transition. At some point, income peaks. At some point, children leave home. At some point, priorities shift. If your financial identity was built entirely around growth, you may struggle with maintenance mode. But maintenance is not failure, it's evolution. The mistake is viewing every season through the same lens. After 45, growth may look different. It may look like depth instead of scale, like relationships instead of revenue, like health instead of hustle. And if you didn't allow your financial mindset to evolve, you resist the very shift that could bring peace. The truth is, financial mistakes after 45 are rarely about ignorance. They're about inertia. Small patterns repeated long enough that they become identity. And identity is harder to change than allocation percentages. But it is still changeable, and that's the part I want you to hold on to. Because if you're listening to this before 45, you have something incredibly powerful. You have awareness. You can build margin intentionally. You can protect liquidity. You can stretch your skills. You can define enough. You can align lifestyle with values instead of ego. And if you're already past 45, the story isn't over. The biggest mistake would be assuming it is. Because flexibility may shrink with time, but wisdom expands. And wisdom, when paired with action, is leverage. The goal isn't to look back without mistakes. That's impossible. The goal is to look back without misalignment. To know that your financial structure supports the life you actually want, not the life you thought would impress others. After 45, regret isn't about numbers. It's about alignment. And alignment is built in small, honest decisions made consistently over time.